But let's talk about what the global setup is looking like. And we've been talking about as to how the US CPI print has now made a case for a September rate cut, perhaps. So let's chat a little bit more about that. We've got Anurag Singh joining in on the show. Anurag, hi, morning to you. And wanted to understand whether now it seems evident that the rate cut is going to be sooner than later, perhaps.
Yeah, Aisha, morning. Of course, I think all that we expected out of this report, I think this report couldn't have been any better than the way it is now. Specifically, the housing, the shelter inflation, I think that also rolled down to 0.1%. And eventually, I think after a kind of a seasonal heavy Jan, Feb, March, I think the last quarter has been pretty much in line with what Chair Powell would have expected. So I think the sense is now that, almost now, look, the last rate hike was almost a year back. It's almost more than a year since the last rate hike was done. And I think the control that Federal Reserve lost, in the transitory phase, I think Fed seems to have now got the control back in their hands. So they like the stance. And the sense is now they also realize, and I think Chair Powell has said this umpteen number of times, is that they understand they won't wait for it to get to 2% exactly and then, because that will be too late. So yeah, I mean, Aisha, our sense is that we should get about 2 rate cuts this year, and we should not really rock the boat too much. And I think even if we are at 4.75 to 5%, that's a limiting enough rate for the economy not to run away. So yeah, all good. I think trend is following 3 good months in a row. I think September looks like a first month for a rate cut.
Anurag, what do you make of the flows from FI side towards emerging markets and India in particular?
Yeah. So Ajay, now that's an interesting one, and I heard Nikunj's take on that as well. Look, we all know it follows a 10-year yield pattern, right? We understand after 2008, since it was pretty much zero, 10-year was close to hovering between less than 1% or thereabout. So we can't compare the historical flows to this new phase that we are in. My sense is, Ajay, that ultimately if the 10-year, even by the end of next year, goes till say about 3.5, that's an attractive number for US investors, but that's not attractive enough for them to really open the floodgates investing into emerging markets. The second point, Ajay, is that look at the emerging, and I understand historical perspective has a different meaning, but last 10 years, the emerging market index on MSCI has barely given like about 3% returns, right? So different markets might have had their own problems, but at an index level, if MSCI emerging markets is giving 3% on a 10-year basis, that says something. So that's the second stoppage. Third is the relative valuation of India, Ajay. I think we can talk about it. I understand that India's centric analysts have a very different view of it. But I think that people that I speak to, Ajay, I think they are largely okay to miss this one out, because I think the range in which Indian markets have gone, that really has spooked almost all the FIs and all the international investors. And they don't want to really catch this running train, especially so late in the game. That's the view, Ajay. I understand flows might increase incrementally, but I mean, nothing great. I think maybe 15-20 billion a year. I mean, that kind of a number can always be flowing in. But that's the larger view, Ajay. That's my headset. And by the way, I must add, look at China and Korea and some of the other markets. They've become relatively much more attractive. So that's also acting as a balancing competition. Retail investors look at the past 5-year return and then jump in. But FIs would look at the last 5-year returns and they probably will take the other direction. Ajay.
Anurag, thanks a lot for that.
If you like this video, then like, share and subscribe to ET Now.